This segment is going to look at the preparation of a bank reconciliation as an internal control tool. A bank reconciliation is prepared regularly, typically monthly, to explain any differences between the cash that is reported on the bank's monthly bank statement and the balance that the company currently has recorded in the general ledger. Reconciliations should be done regularly to help identify any bank errors or any transactions that were recorded by the bank for which the company had not been aware and had not yet recorded. The bank balance and the general ledger cash account balances are regularly different due to timing differences. And by timing differences, we mean transactions that are recorded by one but hadn't been recorded by the other side at the time of the bank statement. And the reconciliation will explain the difference between the bank balance and the general ledger cash balance. So looking at the bank statement ABC received on the 31st of July, the bank reports them having a cash balance of $9,610. But when they look in the general ledger, on July 31st, the general ledger is reporting a cash balance of $7,430. Preparing a bank reconciliation will explain the reason for that difference. Balances. The way we do that is to prepare a reconciliation that kind of looks at the bank reconciliation in two parts. One side of the reconciliation starts with the balance that is reported on the bank statement for cash and adds in any items that the bank had not yet recorded or processed. The balance on the other side of the reconciliation starts with the general ledger cash balance and adds and subtracts any items that had been reported on the bank statement, but that the books did not know about and had not yet recorded. When we take the bank statement balance on the bank side of the reconciliation and add and subtract all of the reconciling items, we end up with an adjusted balance on the bank side. We do the same thing on the book side. Start with the cash general ledger balance, add and subtract reconciling items to get to the adjusted book balance. When we compare the adjusted balances for the bank and the adjusted balance for the books, the two should be equal. If they are equal, it means that we have properly reconciled and explained the difference between the two balances. The very first thing we need is the two balances, the bank statement balance and the cash general ledger balance. We will come back to this additional information in just a moment. So here we are with ABC Company. We have two balances. We have the balance that's reported on the bank statement, and we have the balance that is reported in the general ledger cash account on July 31st. The first item that the company has identified there are some outstanding checks that totaled $2,417. Outstanding checks are checks that the company has written to pay for some type of product or service. When those checks were written, the cash was decreased in the general ledger. At the time that the bank statement was cut, those checks had not been processed by the bank. What that means is that the bank does not yet know about these outstanding checks. Because we know it is the bank that doesn't know about this item, we know that we are going to be reconciling this item on the bank side of the reconciliation. We then ask ourselves, will this add to or decrease from the cash on the bank side? Once the bank processes these checks, it will decrease the cash in the bank. Thus, we are going to report the $2,417 of outstanding checks on the bank side of the reconciliation as a deduction from or less its balance. The next reconciling item, a $500 check was mailed to the bank for deposit, but it had not reached the bank at the statement date. This is what we call a deposit in transit. The company made a deposit. When the deposit was made, cash in the general ledger was increased to reflect the cash being received and deposited. However, at the time of the bank statement, the bank had not yet processed this deposit. That means We know it's the bank side that doesn't know about this deposit, so we know we're on the bank side of the reconciliation. That $500 deposit in transit, once it's processed by the bank, will increase the bank balance. So we're going to add the $500 deposit in transit to the bank balance. The next reconciling item. The bank returned a customer's insufficient fund check for $225. That check had been received as a payment on an account receivable. The company received a check and they deposited it in the bank. When they received that check from the customer, they decreased accounts receivable and increased cash. But when the bank went to get the funds from the customer's bank account and deposit it into the company's account, the funds were not available. So we need to ask ourselves, who does not know that this check was insufficient? And the answer is the book side did not know. So we know we're going to be on the book side of the reconciliation. Now that we know that the cash wasn't really received, we need to subtract the $225 from the cash account. The bank statement shows $30 interest was earned during July. $30 in interest was earned, but the books did not know that it had been earned and deposited in the account because the books didn't find out until the bank statement was received. So the books do not know about that item. So this reconciling item is going to be on the book side of the reconciliation. Now that the books know about it, we need to increase cash because interest was earned. Another reconciling item, check number 781 for supplies expense, cleared the bank for $268, but it had been erroneously or mistakenly recorded in the books as $240. The books do not know about this error. We need to correct this error in the books, so we're going to be on the book side of the reconciliation. The check, when it was written, decreased cash $240, but it should have decreased cash $268. We know we're on the book side. We need to decrease cash another $28. So we're going to show this on the book side of the reconciliation as a deduction of $28 to cash to correct that error. Finally, a deposit by some other company was mistakenly or erroneously credited to our bank account. So we're seeing a deposit that really isn't ours. This deposit error is unknown by the bank. So we know we're on the bank side of the reconciliation. Once the bank corrects that error, they will decrease our cash. So we're going to show the bank error as a deduction from the bank balance. Now that we have gone through all of our reconciling items, we take the balances and add and subtract the reconciling items on each side. We end up with adjusted balances per the bank and adjusted balances per the book. Because those adjusted balances agree, it means we have successfully reconciled and explained the differences between the two balances as of July 31st.